Hey, Andrew here from The Investor's Way, and welcome to Woody's Weekly Wisdom, episode number 3. And thanks so much to everybody who's provided feedback on the first 2 episodes. It's been really encouraging, and it's great to know that you're getting some value from these weekly wisdoms. And once again, I'm delving into something or a headline with a bit of news behind it that I saw this week. And I think there's some interesting messages that are coming out of this data. It's Australian-based data, but again, we can apply it to most of the Western world in terms of what we're seeing around the world at the moment. So let's have a look at it. It says households tighten belts as interest rate and inflation pain kicks in. So if you've been following along, this is a headline of a reaction that everybody's been waiting for in terms of, in Australia, for those who don't know, we've had 9 interest rate increases in the last 9 months. So one every month for the last 9 months. And everybody, I guess, who's observing, who's reporting and interested in what's going on in the financial markets has been waiting for the time when these interest rates effectively started to have a massive impact on households. So we know for a fact that interest rate increases tend to take about 3 months to filter into the household budgets. And I hate that word budgets, but let's just use it for the sake of this conversation. So a 3-month delay means that in Australia in particular, the last 2 at least, and potentially third, interest rate increases are yet to actually filter into impacting household spending. And that's a pretty scary thought, because if we're already starting to see these headlines after effectively 6 or 7 of these rates, and we've had 2 more or 3 more since, and even more scary, talk of 3 more to come, then we're probably in for a fairly rough ride. And so this headline to me is the first evidence that things are turning. And I want to go through this article and just show you some key statistics that are sending a message. And you as a household CEO are probably already seeing these in your own personal circumstances. And the people that I'm working with at the moment are telling me different stories about how this is impacting them. But progressively, higher interest rates are having a very significant impact on people's ability to continue to manage their money and grow their wealth. And so this first early stuff is all about just general growth. But some of the things that I think are important are in this graph here. So what you can see here is obviously with Australia and our COVID lockdowns, the red line there is our discretionary spending. So as households, when we were all locked up, it was pretty hard to spend money on discretionary items. I know we did a lot of online shopping, but you can see here that we had massive spike down, then we've spiked up after we've come out, and then we've gone locked down again, so it spiked down again, and then it spiked up post that COVID period to quite high levels. And now it's coming back down to more stock standard type levels. And you could almost say that this was the peak before the interest rates kicked in, and now we're starting to see people really having to pare back their discretionary spending. And we've seen that certainly in the US, where we've seen their inflation rate starting to fall. That's happening because their interest rates have had an impact, and so they're seeing a reduction in consumption as well. So this is just a general, fairly, they say a picture tells 1,000 words. Well, this is telling us some fairly significant detail in terms of, our discretionary spending has come back to a normal level, And it will be interesting to see if it starts to then crack through that 0% line, which suggests that we're contracting even more as we go forward. So that's one we'll keep an eye on for you, and just give you a bit of an understanding of what that means to the future of interest rates and things like that. And this sentence here really stuck out to me, this one here in particular, where it says that there's been a 23% surge in the amount of money being eaten up by interest payments. So what that's saying is that from your monthly cash flow, 23% more than previously was being taken up is being used just on meeting your interest payments. So that bites pretty heavily. 23% is a big number, and it means that 23% that you may have been spending on other things or allocating to other things is now got to be redirected to meeting your interest payments, which will force you, no matter whether you like it or not, to make adjustments elsewhere. And what we've been seeing is that a lot of people have been, because of the COVID period where we couldn't spend our money, so a lot of people were putting extra money onto their mortgages and getting ahead of the curve when it came to their mortgages, which was fantastic. But with this surge in interest rates, which is unprecedented in terms of the aggressiveness and the rapid rate that they've gone up, is that people have been forced to start eating into that. And the scary part about all of that is a lot of people are now getting into a position where there's not much left of excess when it comes to their mortgage position. So they're getting back to a position where they've just got to make their monthly payments to just stay up to date. And so that is going to make an even bigger impact. So with those interest rates really, in the next quarter, I believe we're going to see some really tightening of the belts going around, and in terms of discretionary spending, I would not be surprised if we saw a massive contraction and a drop below that zero line. So that just means we're spending less than the previous quarter. I think we're going to have to see that in order to rein in inflation. And it appears that governments all around the world feel that the only way to smash the inflation problem is to hurt the hip pocket of household CEOs, rather than potentially looking at government policy and looking at ways and means to potentially solve a war. I don't want to get too political, but just beating household CEOs over the head all the time with interest rate rises and making them do all the hard work seems to me to be a little bit counterintuitive and a little bit lazy in that respect. So certainly we're moving into a very interesting and potentially difficult time. And this is a graph that I was just effectively talking about. You can see through COVID we had all this extra household savings, and that is now being chewed up, and it's now getting to a level that it hasn't been seen for a long, long time. And so that's very dangerous. I think the Federal Reserve and the Reserve Bank here in Australia, they will be very, very cautious of this household savings ratio dropping too much further, because that then leads to that dreaded R word, recession. And I think the central banks around the world are very, very cautious about being blamed for forcing economies into a recession through being too aggressive with their interest rate rises. And I know in a separate headline that I saw earlier this week, there was talk of, have they gone too hard too fast, and is it time that they started thinking about reducing interest rates? So that's an interesting thing as well to keep an eye on. There's so much news out there at the moment that it's hard to separate just one particular topic for these episodes. So it's great for me. I've got plenty to talk to you about, but I just want you to be mindful of what is going on so that you can do some planning. And like I'm all about planning your money and having a plan for your money that meets your lifestyle needs and certainly your future wealth needs. So we really want to make sure that we do that in a way that is manageable as well with what you've got going on and what's going to happen in the future. So we need to be mindful of what might be coming down the track so that you can plan for it. And this is what I'm trying to do with these weekly wisdoms, is give you a bit of forethought on what's coming. So my view is that, and this is just my view, but my view is that I think the banks are going to have to ease up on the interest rate rises. The more of this data that comes out, rather than opinions, but cold hard data, the more of that data that comes out and suggests that economies are slowing down and that the current interest rates have already had a significant impact on people's ability to meet their expenses, that will be extremely important, and that is going to have a massive impact. And so, we've seen here rents are going up, which is is normal at this time. And you'll also see, I think there was something else in here I wanted to have a look at. Well, just taking a step back here, you're looking here at, say, energy bills have soared. And I know in the US this is a big deal as well. And the funny thing about this, and this is something that irritates me all the time when it comes to talking about inflation, is that our energy bills are effectively set by regulatory bodies in this country that are ultimately owned by the government in most cases. Now, I know there's been some outsourcing and some sale of assets and all that type of stuff, but ultimately the government gets to set the rates to an extent, and they're putting energy rates up and then saying that we have to slow down our spending because the inflation's going up. Well, to me, that's a double-edged sword. If you keep putting prices up, then we have on essential items like energy that we have to pay, or interest rates on our mortgages, which we have to pay if you have one, then it becomes a bit self-fulfilling, and that's why I think it's harsh that they use interest rates to smash us all the time, rather than look at some of the things they're doing in other areas that could be more impactful on bringing that inflation number down. So that's my rant, and that's my political statement for the week. And like I said, there's plenty of stuff going on out there in the world. And this article, like I said, it just highlights, let me just go back to the headline, it just highlights that these interest rate rises that we've seen around the globe are starting to impact people's ability to meet their costs. And when that happens, everything slows down. So be very, very mindful of people out there who are spruiking that we've seen the bottom. I don't think we've seen the bottom of anything yet. And particularly in property, I saw just a news flash the other night where somebody was suggesting that the property market has bottomed and we're about to turn around and go back up again. And I think that is laughable. With the headlines like this and the knowledge that there's so many people out there who are about to come off fixed interest rates and go into a much, much higher variable rate, I think there's going to be a lot more hurt in the property market before we see those returns to positive gains. Now that's a little bit manipulated, obviously, not in a negative way, but in times like this, there's less people selling. And that means if you have to be buying at this time and there's less stock to buy from, then natural supply and demand suggests that there's potential that you're going to pay more for something, because if you want to get it, you've got to outbid the other person or people that might be looking to get something. And when there's low stock, that tends to lead to some increases. But it's a false economy to suggest that the property market as a whole is about to bottom out and turn around, particularly with so many people who are potentially going to be in some very, very difficult positions because of positions they took under the premise that rates weren't going to be rising at this type of rate for some time. So they're my thoughts on the tightening of the belts that is happening. I think it's a natural thing that they want to see. And if you're struggling and you don't have a plan for your money, and so you're just kind of like juggling, then reach out, let us know. We might be able to help you with some resources to get a plan for your money and help you navigate your way through, so that in time you can get that money working for you and securing your financial future. And I think the last few years, both with COVID and now this high inflation environment, have done nothing in terms of the positive that they've shown us. They've definitely shown us that if nothing else, make sure you have a plan for your money so that you can be securing your financial future in the good times and for the bad times. And unfortunately, I guess the good times just rolled along for so long without any real pressure or turnaround that people forgot about these times and life was a little bit easier. So to me, it's just sent a message that more than ever, you've got to have a plan for your money. And if you want one and you need some help, then reach out, whichever method suits you, to get in touch with us and we can have a chat. And if we can help you, we'll find a way to make that happen. So that's it for episode number 3, where we talked about households tighten belts as interest rate inflation pain kicks in. And we now have a better understanding of what that means. And I look forward to seeing you for episode 4 next week. And if you've got any questions or if you've got any feedback on these episodes, feel free to reach out, leave a comment below. We'd love to hear what you've got to say. And we're really enjoying putting these together for you. So have a great week. Cheers.